Hey everyone, welcome back. I hope everyone is doing well. So, very recently, my portfolio touched $250,000. And whenever it touches $250,000, I like to call myself a quarter millionaire. Everyone that has been listening to me knows that my goal or the long term goal is to get my portfolio to $1 million. Just a bit of background, I started investing or I bought my first VOO share on September 23rd, 2019. And since then, I think we've seen a lot of ups and downs in the market. And I've, thought a lot about investments and, the mistakes that I've made. And I thought I'd lay out some of the mistakes that I've made or the way I think about the market. I think these are going to be my guiding principles going forward. Now, one thing I would like to say is that these are just my own opinions on whatever has happened with me. These definitely are not financial advice. I could be wrong, but I think these have served me really well. Obviously, you make your own decision, but I think these have served really well. And I think, they are worth sharing and worth documenting. I really, get excited by the fact that one day my portfolio will be $1 million and I'll look back at my journey through these documented videos and, just be happy and satisfied as to how long I've come. And again, I am not a financial expert who knows a lot about investments. So I'm doing a lot of experimentation on myself as I go along. But again, I thought of sharing some of the mistakes that I've made. But before that, just a quick portfolio update. I'm at $243,847 as of today, which is 5th of April 2022. I started making these videos on Jan 6th of this year, if I'm not mistaken. And I feel like I've come a long way since then, because there's been a lot of ups and downs in the market. I think the market started to go down as I started putting my videos on YouTube. But I'm happy to say that, my first video was at $240,000 and I'm currently sitting at 243,847. I have said it multiple times in my previous videos. I'm well aware of the fact that this could all collapse tomorrow. And I'm okay with that because I know that if I stay invested, I think that's the more important thing than looking at it from a very, short-term basis, a weekly, daily, and I've made the mistake of looking at it hourly. I know I've been pretty busy over the last few days and I've not been looking at this, but every now and then I have a sneak preview or a sneak view into this. And I feel very happy that, the last few days have been really good. I started as a dividend investor. I really am, still, I think what gives me the most satisfaction is the dividends that come into my account. I'm at about $2,100 per annum, which is close to $200 a month. And now that it's close to $200 a month, I know that my investment budget was $1,000. So I don't need, all of $1,000 coming from my salary. As a matter of fact, or savings. As a matter of fact, I now only have to figure out how I get $800, and the $200 is usually the dividends that go back into the market. So I've been very happy about my dividend growth. I really want to make it $500 so that I have some extra cash to spend with my kids. I think that dividends will help me get there. But again, I started as a dividend investor. Somewhere along the lines, I started investing in growth stocks as well. I have a good mix of growth stocks and a good mix of dividend stocks. I still make investments where, my investments are, weighted more towards dividend stocks than the growth stocks. But, every now and then I sort of, change, but this is where my portfolio is today. I'm very happy. If you look at it, September 23rd, 2019, and today we are at 5th April 2022. It has grown quite a bit. And if you look at it, I've seen a growth of $100,595 in the last 2.5 years or so. So I'm very, very excited, very, very happy. I haven't bought a home. I know people who bought homes and real estate. Their growth has been through the roof. But again, I have mentioned before, as an investor, I do not understand real estate, and I did not have enough money to buy a house as I was, looking to find an opportune moment, but I was not able to find one. hopefully I'll buy a house soon. But anyways, this is where my portfolio currently is, and I thought of sharing the things that I've learned by being in the market for the last 2.5 years. I think pretty interesting stuff. Again, this is my opinion, nothing to do with any sort of expert advice. This has served me really well, and I think it can serve me well even going forward into the future. The first thing that I've learned is do not chase momentum, and I say do not chase momentum unless you're a day trader or you absolutely can figure out a timing where you sort of take your profits. Unless you're a day trader, obviously a day trader is more in line with taking out the profits, but I'm a long-term investor. I've made mistakes in my life, or sorry, in my investing life, where I have invested in a stock because it was going up. I was hearing about it from all quarters. Everybody was talking up the stock. Some of these stocks did not have any revenue line. Some of these stocks did not have any profit, but then everybody's talking it up. Markets are good, everything is going well, and all of a sudden the stock starts to go up. One stock I could say that I'm guilty of sort of chasing momentum on is Asana. Asana is a company that still is in my portfolio and I'll keep it. But there was a time when I entered into Asana just because the stock was moving up like crazy. It was $70, and then I thought, it's going to be $70, and then it's $75, it's $80, and I'm continuously sort of keeping up with it, putting a little bit of money into the market, buying Asana up. But my problem was I did not know when to get out. It went all the way up to 140, and I thought, maybe it'll go up, and all of a sudden the market decided to thrash Asana and I both, and all of a sudden I find it dropping down like crazy. Just the way it went up is the way it came down, and I just could not figure out when to exit, because I thought, look, it might be a short-term thing. It will go up again. It has already been at 140, therefore it will come back to 140. That's not how it works. If the valuation is not right, it's not going to come back to a false valuation number. So unless and until you're very sure as to when to take your profits out, you should not invest. Another one that I did was Dogecoin. I got in at 5 cents, but then it became 15, then it became 30, then it became 35, then it became all the way to 70 cents. I remember I was walking from my place to my friend's place, and Dogecoin was going up, and I was calling my wife up, and I said, hey, can I use $500 from your account, and I'll just invest in Dogecoin. And I kept investing it. I was going like $25, $30. It was going up, and I was like, you know what? And there was a time when I should have taken my profits, but I did not. And where is Dogecoin today? It's at 15 cents. I have invested in Dogecoin all the way up to 65 cents. Was I stupid? Yes. But have I learned my lesson? Definitely. I don't think I'm going to do that again. You probably would get burnt more than gain. So do not chase momentum. Go for good companies. Go for companies that you want to be invested in long term. This is a long term game for a poor person like me, for a person who believes that staying invested in the long run is a good thing. Go into companies like Microsoft, Apple, or Adobe, Pepsi, Coke. These companies are going to stay for a long time. Do not chase momentum. You will be tempted to do it, but I have learned my lesson. I think I've burnt more by it than I've gained from it. So yes, no more chasing momentum for me. Okay, the second point, a lot of people I've spoken to always say that they do not know what to look for when you're investing. And I understand it's not an easy thing. I work full time. Sometimes I work long hours, and not only long hours, sometimes I think of 3 or 4 days ahead, and therefore my brain is occupied. It's always thinking about what's next as far as my day job is concerned. And it's difficult. But you know what, if you're going to be investing into something, if you're going to be putting your hard-earned money, you should know what the industry multiples are. At the very least, know EV over EBITDA, or enterprise value over EBITDA, my favorite multiple. Or no PE ratio, stock price over earnings per share. You keep hearing about the PE ratio. Just Google it, figure out what the PE ratio is, and then make your decision. I'll give you an example. So in 2021, S&P 500 PE ratio was 23 times. That means the price of all the S&P 500 companies combined, or say VOO, divided by the earnings that each company was making, was 23 times. So people were ready to pay $23 for each dollar of earnings of S&P 500. Okay, great. Is that a benchmark? It sure is. I mean, probably, one could argue that S&P 500 is all the industries in it. So it's difficult to sort of gauge what's the right PE ratio, but it's still a benchmark. 23 times, a company that is 25 times probably is a good bet. A company that is 50, 60 times, now you're going into into the realm of like craziness. So let's look at another, you're continuing from the example. Let's look at Block. Trailing 12-month Block PE ratio was 85 times. Now, one could say, Block is different from Coke and Pepsi, and those companies are in S&P 500. But you know what? Block is a technology company, so probably justified. But is 85 really justified? At least know the multiples that you are investing in. Do not just go by the price. Do not say, oh, the price is $10. That could mean a PE ratio of $60, depending on what the earnings of the company are and the number of shares outstanding is. So know this number, the PE ratio. Just see, 85 times. It's crazy. And then more important is technology services industry's PE ratio was 26.43 times. And I've got this from Zacks. And so you can see that if I'm investing in Block, I am basically overpaying. I'm paying 85 times, whereas the industry is priced at 26.43 times. So, if you look at Block's performance, you will see, that paying 83 times, 85 times the PE ratio definitely had its consequences. Block was one of those shares that dropped like crazy, and the market corrected it quite handsomely. So it's good to sort of understand that. See, basically, Block at one point was valued, I think, about 270 or something like that. Currently, it's valued at 135.90. Obviously, in hindsight is always 2020. I can see why that is the case now, because the market said, hey, you're priced too high, and therefore it should be priced down. Remember, market is the smartest thing out there. It is the smartest thing. There is nothing more smart than market. You know why? Because market is what we call market is a lot of smart people getting together and making decisions. And somehow the law of averages kind of gets it right. So that's something to know. Know the multiples that you're getting into. Do not just go by, oh, the stock price is $10, so let me invest in it. No. That's not how it works. The way it works is, what are you paying relative to the earnings that the company is making? Rivian, for example, is a company that, came on board 90 odd dollars in IPO, went all the way up to 140 or something like that. What for? I mean, people were chasing momentum. People were just going after Rivian, everybody talking about Rivian. But it didn't even have a ratio. It did not even have any of these ratios because there was no earnings. As a matter of fact, they were not even sales. So you could not even do enterprise value over sales, so EV over sales. So again, as a prudent investor, I think what I've learned is, look for wherever you can get value. Obviously, you're not going to be able to find these gems, every now and then, but do not go with exorbitant, amounts of, these crazy multiples. Like, for example, Block at 85. Market has corrected it, and I think market is going to correct it even more because it's still far away from where the mean is. So that's something that I've learned. The third thing I would say, and look, not all of us are crazy investment people. We're not accountants, but it's not a bad idea to go and just look at the financials of the company. It's not very difficult, I'll come back to this again, but let me just show you quickly, where I have, gotten this, when I look at Pepsi, for example, I just went in on Google. I just typed Pepsi IR or Pepsi 10K, which is the annual report, and that gives me the annual report. And this is the annual report. All you need to do is do nothing. Just go in, search for balance sheet, and it'll take you to where the balance sheet of the company is, and just study the balance sheet. Just look at it, and I'll show you what are the simple things you need to look at when you're looking at a balance sheet. So when you're looking at a balance sheet, just look at how their debt is, and where does debt sort of live. It lives in liabilities. So you can see that short-term debt obligations, 4.3 billion, and then liabilities held for sale. There are certain other nuances. You don't have to sort of look at all this, but look at long-term debt obligations and short-term debt obligations. There's the long-term debt, and you can see that Pepsi's long-term debt has sort of reduced year over year. It was 40.3 last year. Now it's 36. That's a good thing. You can also look at the debt and divide that by the assets and see if that ratio is improving year over year. You don't have to go through crazy financial analysis and stuff. It gives you the sense of, is this company making prudent financial decisions or not? Is this company, in the business, and is the business kind of going in the right direction or not? Another thing that I would say, one should look at, and again, which is close to the balance sheet, is the income statement. It's again, so many people invest in different companies, and you ask them what the sales of the companies are, they don't know. So I'm glad to know that Pepsi, who I think is a great investment as far as my portfolio is concerned, has been growing its revenues quite steadily since 2019. We're at $79.4 billion. And therefore, I know that at least the revenue growth gives me some comfort that the stock prices continue to grow. I should watch this number as every quarterly earnings come out. And the other thing, another thing that is, probably a good idea to check is the profitability. And it's right here. Net income attributable to PepsiCo was $7.6 billion. It's increased from 7.3 to 7.6. Unfortunately, this does not give you the ratios, but you can easily divide the net income or the operating income by net revenues and get your own ratios. If you see these ratios declining, you can see that there's some problem. You don't have to go into these statements and sort of say, oh, look, where do I do my analysis? What might be happening? Leave that. But as an investor, know the revenue of the company, know the profit of the company. At the very least, the revenue, volume, and the net income rate. At least do that. Don't just go by, your friend said invest in this company, or that friend said invest in that company. Don't go by that. When you do at least this kind of due diligence, it gives you some comfort, and it also gives you a sense of satisfaction that you are not investing in a company just because somebody said so. So as I've mentioned, revenue growth, check that out. It's very simple. Go to a company's financial statements. You can find them on the investor relations website. You can also find them, just Google and say the latest annual report of Pepsi. It'll go to the income statement. On top, there's revenue. You can calculate the revenue growth year over year. Look at the debt. As I mentioned, go to the balance sheet. Look at the debt and see if the debt has been growing. And usually debt, long-term debt and short-term debt, it's right there. There's a line there for total assets. You can do some ratios. You can divide the debt by total assets and see if those are going up or down. Despite the fact that debt might be going down, the ratios might be still unfavorable, from year-over-year perspective. Do at least that due diligence. It's very cool to sort of, be investing in a company and say, hey, how much does this company make in revenues? $79 billion. Okay, great. At least know that number and maybe the growth rate. As a long-term investor, if you keep a tab on how the revenue is growing and how the profitability is growing, how the debt is growing and how the assets are sort of growing, at least it does not give you a full picture, but it gives you something to look at. And I always look at the debt of the company. Will it be able to sort of make its payments or not? And last thing, obviously, I've mentioned margins, and I just put a snippet of the income statement out here, and I said, net revenue and then operating profit, and you divide the operating profit by net revenue, will give you operating margin. So it's very, very, very important. I think you should do your due diligence. Do not invest in a company I mean, I just heard of Rivian. If I had gone in and looked at their 10K, I would have seen they didn't even have a net revenue line. Can you imagine a company coming up with an $8 billion valuation and they don't have a revenue line? That's kind of crazy. So as a long-term investor, that's what you need to check. And what happened to Rivian? It went to 140, and now I think it is at $40. So what happened? Markets straighten each and every investor who thought this Rivian company was a crazy deal. They straightened it out. Anybody who would have bought this stock at $140 lost $100 per share in Rivian. Why? Because the valuations were just crazy, just crazy. So again, my advice for myself is that I am never going to invest in a company without looking at some of these basic metrics on their annual reports or even their quarterly reports for that matter. But just look at the income statement and balance sheet. It's very simple. It's not rocket science. The craziness of accounting is done creating these things, but that is an output. You can easily look at the output and you should be fine. Okay, next one. This is very interesting. When I started investing, I really like to listen to Jim Cramer. I actually still like to listen to Jim Cramer, but not anymore for any investment advice, because this guy, I feel like with like any other guy, flip flops a lot. Don't invest based on what some expert says. Unless you want your investments to be steady, and hold your line. So I know he says his show is Mad Money. I just call it Bad Money because I think it's bad money. And he comes up with this like, the entertainment value is there when he says buy, or sell. It's great, but do not rely on experts. There's so much material on, on Google. Just Google it, just figure out what the value proposition is and invest in those companies. Do not just listen to some guy on TV and say, hey, this company is coming out. Oh, let me invest in this company. By the way, I do not know what they do. Well, actually, I think most people hopefully know what the company does, but they also don't know what the revenues are. They don't know what the profit margins are. They do not know what the debt situation is. At least those things you should know. And invest in long term. You're not going to go wrong with most companies, most steady companies, like I'd mentioned: Apple, Microsoft, Pepsi, Coke, Adobe, and so on and so forth. The next thing is go slow and steady, because small investments, are also good investments. So I've mentioned this before in my videos. I never invest like $1,000, $2,000, $3,000, or $4,000 in a single security. I go very slow into a security. I just go with like, for example, I bought $10 for Shopify, worth of Shopify. Why is that important for me? That's important, because of a psychological factor. Let's say I take $5,000 and I go in and invest into Shopify. And then at the price of $699.59, let's assume that. Then assume, or not assume, but I've actually invested $10 at $699.59 into Shopify. What happens is, let's say Shopify all of a sudden starts to go down for whatever reason. Something comes out, there's some problem with the company, whatever it may be, market conditions, it could be anything. Now, when $10 dip by 50%, let's say, that's dramatic, but still, let's assume it's 50%, it's going to go down to $5. But when a $5,000 investment dips by 50%, it's going to go to $2,500. Do I care about my $5 that I've lost? No. My coffee sometimes is more expensive than that. So I don't take much action. I don't care. But when the $5,000 go down, I will take action. So therefore, sometimes you might have, at least I've noticed, when I used to make big investments, I used to say, as soon as I make my investment, the market starts to go down. No, even with small investments, sometimes the market starts to go down, except I don't make any adjustments because this amount is small. So for anyone who is starting out, do not get greedy, slow and steady. You have $1,000 divided into different securities, and slowly, steadily, at a very comfortable pace, start making those investments, because psychologically, big money invested into the market it is a bigger hit, or a particular security, it is a bigger hit that will force you or compel you at least to do something. But my 10, 20, 15, $5, sometimes $1, $2, I bought Tesla for $5 here just because I had $5 lying around, and I thought, okay, fine, I'll put it in Tesla. It didn't matter. I didn't even think about it. Morgan Stanley, I put $9.88. My investment history is just full of these 5, 10, 15, 20, $25. And I just keep on making these investments and I forget about it because the amounts are small. I don't care if I lose $5, but I will care if I lose 5,000. So my advice is go slow and steady. Even going forward, I'm going to keep going slow and steady into the investments, because even a dollar invested means a lot. Don't think a dollar invested is just wasted. No, 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 no. Anything invested is good. So go slow and steady. That has really been very, very helpful for me. The second thing, or not the second thing, the sixth thing I think I'm going to say is dividends are man's best friend. Honestly, this, to me, the kind of person I am, I love dividends. They come into my account every now and then. Like, for example, this one on March 29th, I got $74.89 because of the Vanguard VOO shares that I own. I just love it because I feel like some poor soul worked really late night for me, and I got paid just because I invested in these securities, and I was sleeping while doing that. Don't get me wrong, I also work late for the investors of my company that I work for. But you know what? This is my money working for me. This is purely passive income. Every year, at least starting this year, I will be at $2,100 if I don't change anything. I'll be making $2,100 without doing anything. $2,100 can do a lot of things. You can reinvest them back into the market. I could buy a life insurance. I could go on short trips. I could, reduce the amount of investment by the amount of dividends that I make. So I think dividends are absolutely my best friends. When I'm in doubt, I just only reinvest my dividends. I keep checking. I check my history and see where my dividends are coming. I think the third month of every quarter is my most amazing month. There's always something happening, something crazy, number of dividends coming in just because of the companies releasing their dividends. But do not underestimate even small amount of dividends. They are very, very, very important. I started as a dividend investor. I've invested in growth stocks, but I think it's very, very, very important to sort of, look at dividends as passive income. Just like you're sleeping and somebody else is working for you and sending you a check, even though it's small today, but one day it's going to be big. Imagine if I can get to $12,000 in dividends every year. That means $1,000 I'm just going to get by just sleeping in. That's it. I don't have to do anything. Some other person is working for me. That's the power of passive income. And that's where, I think the real, happiness sort of lies as far as wealth is concerned. Obviously, I don't want ever to not be working. God, I really want to be working all the time. That's not the intent. The intent is collecting a check from various sources when you have not sort of, done a lot of work. That's an awesome feeling. So I am a big proponent of dividends. I think everybody should have healthy amount of dividends making companies in their portfolio. I have a few. I'll be providing an update very soon, but you know what? It is absolutely amazing. All right. The next thing I want to talk about, and I'll make a separate video on it. I have done quite well, I feel, because I have been able to trade pre-market and post-market with Robinhood. Although it's only for half an hour, it was only for half an hour, but there are some wild swings that happen pre-market and post-market that if you really watch the market, you can take advantage of it. I just got this message in Robinhood on April 4th that there's new extended hours are here. You can actually trade 7 to 9:30 a.m. and 4 p.m. to 8 p.m. EST. What does that mean? It means that pre-market, all the robots are doing their thing. Sometimes the security drops, some news comes out or something happens, the security drops. If you're awake, you can actually get advantage, you can get into it. Sometimes a security spikes. You can actually sell a security. I don't usually want to sell my securities. I have, you know how I built my Tesla, and this is a crazy story. I have been able to build a lot of shares of Tesla because there was a time when I would, at work, I work Pacific time. So at 1 o'clock on the day of the earnings, I would put a lot of money into my Robinhood account. This was early days when I started investing. I would put, like, relatively speaking, $2,000 or $3,000. Then I would wait for the Tesla earnings to come out. Because I was trading after hours, I was able to sort of, all of a sudden, a Tesla, some news comes out where, Tesla stocks drops, whatever it may be. And then all of a sudden you'd see an uptick as to, the Tesla stock starts to go up as the earnings starts to unravel and so on and so forth. And I was able to get in a couple of times at least, at the drop price, and then the price would go up like $50-$60, and then you would, get a gain of $200 doing, absolutely just watching the post market, post earnings call. So I think for anyone who can actually trade outside of the regular market hours, it could be a good thing if done right. So again, not for everybody probably, but I think for me it has been helpful. I don't do it anymore, and I said I just go slow and steady, few dollars here and there. I do not put $2,000 anymore. I was crazy at the time, but I think this definitely can help. Last but not the least, I've learned my lesson, especially in the last few months, that you most likely won't outsmart the S&P 500 index, returns. So I've been lucky. I think, if you look at September 23rd to April 5th, 2022, my returns are 70.2%. That's 100,593. I'm so thankful that, that's what my returns are. But I also rode a very good market. I rode that Tesla up and down. I invested in Apple quite a bit. I invested in Microsoft quite a bit. The companies that have grown quite a bit in the last few years. And I also, got into some companies back in 2019: Home Depot, Target, and so on and so forth. And these companies have grown quite a bit because of the pandemic. And if you look at S&P 500, S&P 500 returns have been, they've been fine. I have been able to beat them, but I think, because I've kind of said, like, you will not be able to outsmart the S&P 500 returns unless you're lucky, which I definitely was, or you're not investing. Actually, you know what? If you're not investing, you're not getting any returns. So I think lucky is the only thing I could say. So going forward, I'm going to put 50% of my money into S&P 500. The rest is going to be all these, like, dividend stocks or, growth stocks and so on and so forth. Just put your money into S&P 500 and you're going to be fine. Even if you only bought VOO, you would have done so well. 51.2% return since September 20th, 2019 up until now. I would have taken that any time of the day. And you know what? It would have also made me, sleep a little bit better, as opposed to my investment portfolio where I've got 70.2%. Anyways, guys, this was just a very, simple summary of what I've learned over the last, couple of years or 2.5 years. A lot has happened. I'm very happy that I invested, and I definitely want to continue to invest. I think American economy sort of gives me that opportunity to invest, and I want to take an advantage of it. But everything starts with savings. If you don't save enough, you're not going to make enough to, you're not going to invest enough. If you don't invest enough, you're not going to go anywhere. So anyways, thanks for listening. I really, hope you found this interesting. But again, I will reiterate, this is something that I feel has worked for me, not an investment advice. I've experimented a lot with my own money to sort of, to get here. But I'll keep providing, updates in the future as well. Thank you. Take care. Bye-bye.